The stock market has recently suffered great losses, but billionaire Chamath Palihapitiya predicts that more are to come. He has developed several theories and analyzed when the best time is to purchase stocks. In this video, we will examine the factors behind Chamath's prediction and hear from interviews done by Chamath himself. Stay until the end of this video to gain expert insight regarding a possible recession, when to buy stocks in the market, and a whole lot more. During the last several months, numerous billionaires and investment managers have issued dire predictions about the economy. One of these people is billionaire hedge fund manager Chamath Palihapitiya, who has lately been raising concerns about the repercussions that could result from the steps taken by the US Federal Reserve. We've seen what comes when the Fed prints too much money. The inflation rate started to skyrocket, while at the same time, financial markets reached all-time peaks, and the level of speculation reached dangerous heights. The economy is affected by a lot by the Federal Reserve. The Federal Reserve's response to inflationary pressures will determine the hazards that lie ahead in the future. This response has caused much concern among fund managers, analysts, and ordinary investors. Chamath suggests that investors focus on an entirely new indicator in their analysis. The Federal Reserve is committed to shrinking its balance sheet and hiking interest rates to battle inflation. Millions of individuals around the world have voiced inflation anxieties. However, it appears that these fears may be a self-induced prediction. The widespread acceptance of that viewpoint drives the Federal Reserve to take an adamant stance, precisely as the Fed did when the pandemic began. The Federal Reserve may be overreacting once again, although Chamath thinks inflation might be more short-lived than many assume. He thinks this is because the Federal Reserve may overreact. A renowned investor named Jeremy Grantham has warned of a market meltdown for the American mega bubble. Grantham described how COVID, the printing of money, unanticipated inflation, and the promise of increased interest rates have all worked together to win the market. Since Grantham previously referred to 2020 as an epic bubble and 2021 as another bubble, the term super bubble was coined to describe the current market environment. In other words, we're in a mega bubble or a bubble squared right now. In Grantham's case, whether his actions match his words is questionable. There are, however, a few fair arguments Grantham makes. In every way, the United States economy is in a precarious position. In Chamath's opinion, a future recession in the United States could be triggered by an overly aggressive response from the Fed. Stocks and bonds have risen by $10 trillion due to government printing of $10 trillion. If the equity market continues to decline due to soaring interest rates, a negative net money outflow will probably occur at some point in the future. Growth stocks and cryptocurrency prices have deteriorated sharply in recent months as proof of this negative net money outflow. David Sachs, a well-known venture capitalist, explained why a recession would likely occur soon on the All In podcast. Chamath concurred with this assessment.
Yeah, I mean, it's more one of these stop clock right twice a day things.
Jeremy Grantham has never found a market he didn't name.
Yeah, exactly. But a stop clock can be right twice a day. And the line he had today is that we're seeing the popping of a super bubble. And we've been talking about
super bubble.
Yeah, exactly. Basically,
but that's not true. But I mean, it's good.
Yes, well, it's evocative.
Well, the sense in which it might be true super is bubble. That I mean, we talked about this last few months. Is that you had the Fed and the federal government pump a $10 trillion of liquidity into the market over the past 2 years because of COVID. Now they're starting to pull that back. And there was, I think, a general asset inflation across asset classes. Certain types of assets clearly got more inflated than others. We've seen a huge correction in growth stocks. We've seen a huge correction in crypto. Basically, anything long dated, as the fear of interest rates increasing has gone up, they've massively corrected. But so the concern is that, with the losses we're seeing, and I mean, every day I keep seeing more red, that this could turn into a recession. Popping of bubbles is usually followed by recessions or So I think, the fortunes of the economy could turn really quickly here. And
that is the marginal risk. The marginal risk is actually for a recession. We talked about this before. By the way, just to your point, you're right that we pumped in $10 trillion, but over the last 3 weeks, and really over the last 2.5 months, we have actually eviscerated $10 trillion of value as well. So if you want to measure it, we put 10 trillion of excess capital in, but we've now destroyed $10 trillion of equity.
Destroyed it by lowering the prices or repricing stuff. Yeah, we've repriced
equity,
everything.
crypto. I mean, crypto in the last couple of days has just been shellacked. Growth stocks have been shellacked. Biotech stocks have been just absolutely smoked. Everything is getting crushed.
COVID stocks.
But David is saying something really important. The risk, in my opinion, is not of runaway inflation anymore.
The bifurcation or divide of the global economy is the most significant indicator of a future recession. Contrary to popular belief, interest rates aren't rising worldwide. While the Fed raises rates, China lowers them. This pattern is problematic for several reasons. One being that a rise in interest rates by the Fed can bring down the economy of China, which is currently in a vulnerable situation. Because China is so important to the global economy, a collapse in China's economy would have a direct impact on the American economy. China's real estate market is undergoing significant deleveraging. Companies deleverage when they sell assets to increase debt. Several other Chinese real estate companies, such as Evergrande, the country's second largest contractor, are currently experiencing a deleveraging. While all of this is happening, Omicron is also affecting China. Lockdowns have been strictly enforced by the Chinese government, which leads to businesses closing. The Chinese economy is seeing a dramatic deceleration in growth as a direct consequence of these two issues. This downturn has triggered a panic among Chinese policymakers. We need a somewhat loose monetary policy. How much we loosen depends on economic conditions, but the policy direction is clear, said Yu Yongding, an economist who formerly worked for the People's Bank of China. The People's Bank of China may also likely reduce the bank's reserve requirement ratio shortly. Banking institutions must keep a certain percentage of deposits in reserve at all times, known as the Reserve Requirement Ratio, or RRR. In this particular situation, the required reserve amount is 8%. If the reserve requirement is reduced to 6%, the bank will have the ability to lend out or invest 2% of its reserves. If the RRR is increased to 10%, banks will be forced to sell some of their holdings to satisfy the requirements. China's reserve requirement was 12%, but in December 2021, the Chinese government cut it to 11.5% from its previous level. In other words, banks now have an extra 0.5% in capital to put to work investing or loans. Taking such a step indicates that China's economy is in trouble and that fictitious cash inflows are required to maintain the economy functioning smoothly. According to an unnamed Chinese policy source quoted by Reuters, we need to loosen policy as the downward pressure on the economy is relatively big. 1 or 2 additional RRR reductions are expected this year, according to Jixin Investments head economist Lian Ping. However, Xu Hongkai, a deputy director at China's National Economic Policy Council, predicts far more volatility. A threefold reduction in the RRR is expected in 2022, according to Xu Hongkai's predictions. China may require more rate cuts due to the US Federal Reserve's actions. As a result of the Federal Reserve's decision to raise interest rates, the US dollar value will rise. The rise in value is because continuing to hold on to dollars would result in better relative returns. Concerning monetary policy, this means that more people will keep dollars than the Chinese yuan. In addition, when the Chinese government cuts interest rates, the yuan's value drops. This hurts the Chinese yuan since investors and institutions sell it for dollars. As a result, the value of the US dollar will increase. In contrast, the value of the Chinese yuan will decrease due to the Federal Reserve's decision to raise interest rates and the Chinese government's decision to drop interest rates. This is important to note. As a result, this exerts significant strain on the People's Bank of China. According to the PBOC, its economic position would be its primary priority. Financial experts around the world, however, believe that it will have no alternative. A situation quite similar to this one occurred in 2018, which ultimately resulted in a moderate manufacturing downturn for the United States. During that time, China's GDP grew at its weakest rate in 28 years. The question now is, how did all of this take place? In 2018, when a trade war was in progress, Federal Reserve Chairman Jerome Powell hiked interest rates, resulting in a significant Chinese economic slowdown. In 2019, the Fed was forced to decrease interest rates because of the considerable slowdown in the global economy. This decision harmed US manufacturing output, which went into a slight recession. Currently, our economy is in a state comparable to the one that existed in 2018. However, this could be even worse. Watch the entire video to learn more about what could precipitate in an economic downturn. Let's now hear an explanation from Chamath Palihapitiya.
Of runaway inflation anymore. And the reason was what happened this weekend was incredibly important. And we have seen this happen just a few years ago. So this weekend, China cut interest rates. Now, as we know, we are dealing in the United States with this issue of whether we should raise rates and by how much, because we're worried about inflation. Well, if you're cutting rates, it's because you're worried about the other problem, which is that the economy is basically turned over and you need to become more accommodating, right? You need to incentivize businesses to spend by lowering.
By turned over, you mean it's slowed down. People are not building, companies not doing new projects. So you want to give them an incentive or maybe some catalyst to start some new company or start some new project because all their real estate projects have wound down.
In 2018, here's exactly what happened. The setup was the Fed, everybody was worried about what the Fed was going to do on interest rates. The Fed was looking at China as the canary in the coal mine, the leading indicator of what we should do. And at the end of 2018, Jerome Powell decided to raise rates. And we raised rates. And then enter 2019, and the Chinese economy turned over. And we realized that their economy was not nearly as strong as we thought it would be. And so our reaction was disproportionate to what the actual data on the ground said. We entered a recession in 2019. That's when you guys probably saw Trump going crazy, blaming Powell. I mean, most of us ignored it because, we were all dealing with, Trump derangement syndrome. But the underlying thing of what he was saying was, hey, hold on a second. You just caused a recession in America by raising too quickly. The Fed is now in this really delicate situation where China cut rates last week. We have an FOMC meeting, the Open Markets Committee that sets rates, on Wednesday, I think, of this coming week. What is he supposed to do?
After projecting an economic slowdown a week earlier, Chamath is now much more pessimistic than he was before. This is due to the fact that the German economy is also exhibiting symptoms of slowing. The previous projection for the growth of Germany's GDP in 2022 was 4.1%, but it was recently revised to 3.6%. According to German Economic Minister Robert Habeck, the country's continuous battle with the epidemic is one of the primary causes of the downturn. According to Germany's National Statistics Office, an additional 0.5 to 1% decline in Germany's fourth quarter 2021 output is expected. That may not seem like a lot, but in the long run, that drop might be anywhere from 2% to 4% per year. All of this is significant because the Federal Reserve may have an overly optimistic outlook on the economy of the United States. It's possible that the Fed's assessment of the economy's strength is excessively optimistic. And if that's the case, raising interest rates will bring the economy of the United States to its knees. Already, we have received indications from China and Germany that the economic situation may be worse than first anticipated. As Chamath explains further, we'll provide you with this clip.
Weekend, actually, Germany decreased their GDP forecast. And so you're starting to see two huge countries already say, hey, wait a minute, we need to be more realistic about what long-term growth looks like here. it's inconceivable in my mind that those countries are slowing down and we won't. And so I think what happens in these other huge GDP drivers of world GDP will affect us. And so, Sachs and I have said this before, but the marginal risk will be that we overcorrect and actually create a recession that doesn't need to be one.
The meeting of the Federal Reserve Open Market Committee, also known as FOMC, which Chamath described recently, took place. During the meeting, Federal Reserve Chair Jerome Powell emphasized the need to increase interest rates and decrease the number of bonds the Fed buys. This provides substantial evidence in favor of Chamath's thesis. When the Federal Reserve decides to raise interest rates, some investors could conclude that this indicates that the market bottom is getting closer. However, contrary to what people may believe, that is not the case. Following the efficient market theory, the market is generally efficient. According to the efficient market theory, all asset prices incorporate information currently available to investors. There are certain flaws in its approach, but even so, it's still essential to a certain extent. The market is now reflecting the fact that investors anticipate further rate increases. After looking into this further, Chamath discovered a pattern of growth in the market after rate increases. In light of this, likely, investors have already factored in future rate increases, and it is now the appropriate moment to begin dollar cost averaging into the market.
Powell basically said, look, we're going to start tightening in March. I think the way that he said it, all of these words tend to be so scrutinized and overanalyzed, but instead of figuring out what people thought, I think their actions post the FOMC are important, which is that, we effectively now started to price in about 5 rate hikes this year. So probably 5 25-point rate hikes. Effectively, that's what the yield curve tells us. If you take a big step back, I just want to remind people, it's really hard to live through volatility, right? And we're in a phase of it now. But typically these big drawdowns, so when stocks go down, it actually precedes, so it comes before the actual starting of a rate hike cycle. And so if you go back to from 1950 onwards today, every time the government has started to raise rates or the Federal Reserve has started to raise rates, the stock markets have actually rallied. Now, why is that? It's typically that they see through the end of the rate hike cycle and they start to price the business as if these rate hikes are done and to rebase things. And on average, I think the stock markets go up between 7 and 8%. So call it 7.5%, 8.5%. And so what's interesting to me is now we're finally starting the process of these hikes. And the real question is going to be, how data dependent do these guys get?
Rate increases are required to combat inflation, but can have disastrous implications. The insistent comments made by Powell provided support for Chamath's argument that inflation is only going to be temporary. This means that if the global economy is sluggish, as China's shown, inflation might soon decline as the economy further slows down. Hedge fund manager Bill Ackman has been putting pressure on the Federal Reserve to hike interest rates more than anticipated. Since Ackman now holds a short position in the bond market, he stands to gain financially if his recommendations are taken into consideration by the Fed. However, that's nothing new for Bill Ackman, who has a history of market manipulation. In March of 2020, he rants about how COVID will get even worse on CNBC while simultaneously selling out his short position and going long in the market.
For a 50 basis point raise in this meeting. So that's way beyond what people even thought is supposed to happen.
We should just remember that Bill Ackman has bets, macroeconomic bets in the market. If he's calling for a 50-point raise, I guarantee you
he's going to make a lot of money.
He'll make a lot of money if there's a 50-point raise.
No conflict, no interest. Yeah.
Exactly.
But my only point is the setup is a very complicated one for the Fed coming into this week. And the risk is to a recession, because if we overcorrect,
yes,
and the leading indicators all around the world tell us that their economies are weak, then inflation may have actually been much more transitory than we thought. And right now we have to decide, because if we overcorrect, we're going to plunge the United States economy into a...
We are aware of the possibility that a recession will affect the economy. However, that doesn't mean that the stock market will freefall. The moderate economic slowdown the United States went through in 2018 resulted in a 17% drop in the S&P 500. This is partly due to the large sums of money watching from the sidelines. Over the last 10 years, more than $11 trillion has been amassed in total savings at depository institutions. That's a great deal of money, and it is sitting there waiting for a good deal to come. It doesn't matter what happens to the stock market because we expect it to increase dramatically with all the money lining up to buy a bargain. In addition, many tech stocks have already plummeted by enormous sums. 40% of Nasdaq equities are down 50% from their peaks. This collapse is similar to past economic calamities. As a result, the market may be nearing the bottom. If the large tech stocks continue to fall 10 to 15%, Chamath predicts that the market bottom is just around the bend. This discovery is an intriguing development in light of recent occurrences. We have seen Meta drop by 26% in a single day, which is a significant indicator that big tech isn't as strong as people have projected it to be. As a result of this event, Chamath reaped substantial financial rewards. In a subsequent episode of their podcast, Chamath clarified this topic more.
Shoot the generals, and his comment was the generals are big tech. When those things trade down 25%, the bottom is in. And I think that collectively, most people think that we're a little bit oversold in all areas except big tech. I think big tech is down 10, 11, 12%. When you see this thing really get cracked is when those folks, trade down another 10 or 15%. And then I think we're kind of through most of the pain.
So Peloton and Zoom were kind of mid-tech. I don't know what we call those, but I would call them like mid-tech. They're obviously not big tech, but they're not small either. Mid-tech gets their asses kicked 50 to 80%. Big tech, 15%. But if big tech goes down 30%, then we start really seeing a bottom. And we consider Netflix part of that? I don't think
you'll ever see that because I think big tech, you have to remember, is basically the index. And in the last 10 or 20 years, you've never seen drawdowns more than 15 to 25%. You've never seen it. And when you've ever had a 15 to 25% drawdown, meaning the market goes off 15 or 25%, you have to remember the thing that we have also done over the last 20 years is created so much money on the sidelines, always looking for a cheap buying opportunity. And so the minute that these things, so even, in March of 2020, remember when we started to do this pod and it literally looked like the world was ending?
Yeah.
The bottom existed for a week.
Yep.
And then within a week, the entire 25% loss in the stock market was wiped out and we were back to normal.
Because of problems with the supply chain, firms have placed orders for an excessive amount of inventory, which has made the situation much more difficult. This is a worrying development, because if the demand from customers is insufficient to absorb the upcoming surplus of inventory, there will be a significant quantity of merchandise just lying around. This issue has the potential to both cause and intensify a recession. On a recent All In podcast episode, Chamath talked with Ryan Peterson, a supply chain expert. Peterson feels that companies may have over-ordered inventory. Chamath agreed with the remarks and identified an impending economic downturn as a potential threat.
Important effect of all of this, which is what happens now in 6 or 9 months, to your point, when the consumption of hard physical assets turns towards the consumption of services, which it typically does, right? If you revert back to the mean here, people aren't going to be buying as many Pelotons and all of that stuff because they bought them all, right? They bought all the physical goods they need. And to your point, these companies have over-ordered all this inventory. Actually, Peloton is a perfect example because they basically shut down their entire supply chain at the end of this past quarter and essentially said our inventory turns will be more than enough to meet, existing demand for the foreseeable future. That's an enormous capital problem that these companies now all of a sudden will face, right? So the next step beyond all of the supply chain issues could be, and I think Sachs has been talking about this a lot, like a pretty bad recession if these companies have all this inventory and they don't know how to get working capital.
It's interesting to note that many crashes were caused by people hedging their investments. Most top-tier fund managers hedge their investment portfolios in some way. The establishment of these hedges may have a detrimental effect on the market. For example, Warren Buffett protects his investment portfolio by holding cash, but Cathie Wood, Bill Ackman, and Chamath hedge their investments by taking short positions. These hedges may be responsible for the current market correction. Chamath stated that he had not witnessed this level of hedging action since the economic downturn that occurred in 2008.
Activity and hedging than in any other period in recent memory except the great financial crisis, just to set the tone of where we are in terms of volatility in the capital markets. Mutual funds who don't short stocks, right? The multi-trillion-dollar mutual fund complex whose only job is to buy has been a net seller. Hasn't even started buying a single thing yet. We have an FOMC meeting.
No matter how far the market falls, as Chamath pointed out, the effect won't be lasting because of the excessive amount of money sitting on the sidelines. The downturn in the market in 2018 was relatively mild, falling only by 17% overall. This is consistent with what we discussed earlier. Despite the uncertainty, the crash could be as minor as the correction of 2018. As a result, now that prices have stabilized, the turbulence has subsided and interest rate hikes have become more widely accepted. Since market rates are based on what will happen in the future and investors no longer trust that they have an edge, investors may want to start dollar cost averaging into the market. A significant change in the market will occur when inflation eventually settles down, then interest rates will halt, if not go back down, according to our forecast. Regardless, it's impossible to pinpoint exactly when that moment will arrive. There is also the possibility that external variables will come into play, such as a slowdown in the global economy caused by China. If factors like this cause the market to continue falling, it might be best for investors to just dollar cost average more aggressively into the market. What are your thoughts on Chamath's insights? When do you think is the best time to invest in the market? We would love to hear your input in the comment section down below. If you enjoyed this video, kindly like and subscribe, and we'll catch you next time.